This slide may look complicated, but if you take a look at the equation in the middle of this slide, you see this is the equation to estimate the value of a company, which is based on the total present value of all the future free cash flows discounted by the VAC. So for example, first year you have FCF1, and that is divided by 1 plus VAC. And for the second year you have FCF2, so that's the free cash flow at the end of the second year, divided by 1 plus VAC at the power of 2, so this is to calculate the present value of the second year's free cash flow. And you sum up all these discounted values, and that's why we say the value of the company is the total present value of all the future expected free cash flows all those years discounted by the VAC. And above this equation, you see we have sales revenue minus operating cost and taxes, and then minus the required investment in operating capital. This is actually the procedure, or say the process, to estimate the free cash flow that the company is expected to generate every year. Below this equation, you see we have weighted average cost of capital, the VAC. The VAC is a mix of the company's cost of debt and cost of equity. The company's cost of debt and cost of equity are affected by factors such as the market interest rate, the market risk aversion, company's debt versus equity mix, and the company's business risk. So look at this whole slide together. We understand this is a description about all the determinants that can affect the intrinsic value, or say the fundamental value of a company. Now let's take a look at the course outline and the last page of the syllabus. You will see that our topics include the following. We have the financial statement analysis, financial planning, and forecasting. These topics help us to understand the free cash flow estimation. And then we'll talk about the cost of capital. And this, of course, is related to the VAC estimation that we saw from last slide. And then corporate valuation. With the time value of money concept and calculation, we can put the cash flow estimation and VAC estimation together and try to estimate the value, the fundamental, or say intrinsic value of a company. So that's corporate valuation. And then we also look at the capital budgeting. This is actually another application of valuation where we try to value a new project for the company. Since we will be looking at a company's cost of capital, or say cost of financing, here we're going to have an introduction to the financial markets companies are facing. In the financial markets, generally there are providers and users of capital. We say households are considered as net providers, and non-financial corporations are the net users of capital. Governments actually can be either borrowers or savers, or say providers or users. U.S. governments at this point are net borrowers, while some foreign governments are net savers. The graph in the next slide illustrates the process of how capital moves. In this slide, we have illustration of different kind of capital allocation process. We'll explain these different kinds of process in the next slide. Capital flows from providers to users in different ways. We have direct transfer. For example, a corporation issues commercial paper to an insurance company. In this process, the corporation is the borrower and the insurance company is the provider. So insurance company actually is providing money, or say capital, to this corporation. That is a direct transfer between the two sides. Another process is through an investment banking house. For example, in an IPO, initial public offering, or in a seasoned equity offering or debt placements, the company sells security to an investment banking house, for example, Morgan Stanley or Merrill Lynch, and this investment banking house will then sell the security to investors and collect money from investors. Or the capital can flow through a financial intermediary, or say a financial institution. For example, if an individual deposits money in a bank and he gets a certificate of deposit, the bank makes commercial loan to a company. So that way the bank takes deposits. The bank is the financial intermediary, or say the financial institution here. It takes the deposit from the saver, and when it makes loan to the company, it's providing money to the company, the business, or say the user of the capital. There are many different kinds of financial institutions in the market. So if we take a look at the list of the main financial institutions, we see commercial banks, for example, Bank of America, Wells Fargo, investment banks like Merrill Lynch, Morgan Stanley, savings and loans, mutual saving banks, and credit unions. So maybe you have seen the Texoma Teachers Credit Union. And then we have life insurance companies, and we have mutual funds and pension funds and hedge funds, private equity funds, or different kind of funds. They are definitely one of the main financial institutions in the market. To give investors, or say the capital providers, incentive to provide money to the capital users, the users need to pay the providers. In other words, the users will have to bear certain costs to raise the money, or say raise capital. Each type of capital comes with its cost. For debt, the cost of that capital is also called the interest rate. For equity, cost of equity capital is also the required rate of return required by the stockholders, or say the stock investors. For any company that relies on a combination of both debt financing and equity financing, we estimate its WACC as the weighted average of the cost of debt and cost of equity. So what kind of instrument or financial securities can the capital users use to raise capital? In the market, we have different kind of financial securities. If you take a look at this table, you see we have debt security, equity security, and we also have derivatives. And usually they are divided into money market securities and capital market securities. So then we have a combination of T-bills, CDs, Eurodollars, Fed funds, T-bonds, agency bonds, municipals, corporate bonds. Those usually are long-term debt securities. And we have common stocks, preferred stocks. We have different kind of derivatives, including futures, forward, options, and we also have LEAPS, which is the long-term equity anticipation securities, and we also have the swaps. Based on the maturity and risk level of the financial securities, we can classify them into two groups. Money market instrument, or say money market securities, are short-term, liquid, and they usually come with very low risk. Capital market instrument or capital market securities are longer term, and usually they are riskier. They include bonds, long-term bonds, equity securities, and also derivative securities. Financial securities can also be grouped into debt securities, equity securities, and derivatives. Debt securities are also called fixed income securities. That's because their payments are fixed or determined by a formula. Debt securities usually come with different maturities. We have money market debt. For example, treasury bills is short-term, highly marketable, and has usually very low credit risk. Capital market debt consists of longer-term bonds, and they can be safe or risky. Common stocks are equity securities because they represent equity or ownership in the corporation. Payments to common stockholders are not fixed. Instead, they depend on the success of the company. Therefore, common stocks are generally considered more risky than bonds, but potentially they could also bring more return for common stockholders. In addition to fixed income securities and common stocks, we also have derivatives. A derivative's value is derived from the price of other securities such as stocks or bonds. Derivatives usually are used to hedge risks or transfer the risks to other parties. Derivatives include options, futures, forward contracts, etc. We just learned that financial markets can be classified into money market and capital market, and then bond market, stock market, and derivative market. That is according to the different products offered in those different markets. Financial markets can also be classified into primary market and secondary market. That is according to the different functions in these markets. Primary market is the market where new securities are sold to investors. By these transactions, investors get new securities and firms get capital or funding to support their projects. After these securities are issued, then investors can trade these securities among themselves in the secondary markets. Securities are exchanged among new and old owners. Issuing firm, they don't receive proceeds and is not directly involved in the secondary market. There are also different types of secondary markets. According to whether the market has a physical location, secondary markets can be divided into a physical location exchange or a computer telephone network. For example, the NYSE, New York Stock Exchange, the Tokyo Stock Exchange, or the CBOT, which is the Chicago Board of Trade, they have physical locations, so they are the physical location exchanges. And the NASDAQ, or the government bond markets, they actually don't have a physical location, and they work based on a computer network system. Also, according to how orders from buyers and sellers are matched, secondary markets can be classified as either open outcry auction market, or a dealer's market, or an electronic communication network. In the auction market, traditionally, participants have a seat on the exchange, meet face-to-face, and place orders for themselves or for their clients. NYSE is an auction market for stocks. In the dealer's market, dealers keep an inventory of the stocks or other kind of financial securities and place bid and ask prices at which they are willing to buy and sell. Computerized quotation system keeps track of bid and ask prices, but the system does not automatically match buyers and sellers. An example about the dealer's market would be the NASDAQ National Market. NASDAQ stands for the National Association of Securities Dealers Automated Quotation. If you have seen some old movies about Wall Street, you may remember seeing people yelling and waving their arms and doing those hand signals on the trading floor. The reality is that thing is getting rare, and more transactions actually are executed electronically nowadays. So we have electronic communication networks, or say the ECNs. The ECN is a computerized system that matches orders from buyers and sellers and automatically executes transactions. So that effectively lower the cost to transact. An example about for the ECN would be for the NYSE ARCA, which is owned by the NYSE Stock Exchange. The Instinet, that is owned by the NASDAQ. So they are the electronic communication networks. In the old days, securities were kept in the safe behind the counter and passed over the counter when they were sold. So that's where the name OTC market is from. Nowadays, the OTC market is the equivalent of a computer bulletin board, for example, the NASDAQ Pink Sheets, which allows potential buyers and sellers to post an offer. In this market, there are no dealers, and securities traded on this market usually have very poor liquidity. For example, American Airlines Group stock has been traded on the OTC market until the company emerged from Chapter 11 and merged with the United Airlines. Since then, it started to trade on the Nasdaq. If you are interested, you can click on this link in this slide for an interesting article that talks about the recent development of the AAL stock price. Now let's have a summary about this lecture. In this lecture, we provide an introduction of finance and corporate financial management. We talk about different forms of business organizations. There are 3 basic forms of business organizations, each having its own advantages and disadvantages. We also mentioned that the objective of the firm is to maximize its shareholders' wealth. Achieving this goal can also potentially benefit other parties such as the customers and employees. However, in corporations, agency problems can potentially cause managers to make decisions at shareholders' cost. We also introduced the concept that the fundamental value is determined by the amount, timing, and risks of future expected cash flows. For a corporation, its fundamental value is the total present value of all future expected free cash flows discounted by its WACC. We'll talk about all the details in the later lectures. We also had a brief introduction about different types of financial securities, financial market, and financial institutions in this lecture. Now let me give you a list of discussion questions that I want you to think about for the Jinzan case from the BES casebook. You can also click on this link on the slide for a video introduction by the CEO of the company. For the questions, first, what is the business model for this company? How does a biotech company succeed? And what does the CEO want for his company going forward? Second question is, what is the business model for the relational investors? How can an activist investor be successful? Third question, what are the RI demands? Are they reasonable? Are these demands reasonable? How do they conflict with Jinzai's business strategy? Next question, in your opinion, how should the CEO respond? And then, is there any way Mr. Termier could have avoided this conflict with which was, or was it unavoidable? Last question is, how does this case related to the agency problem and corporate governance concept discussed in the chapter 1 of the textbook, or say in this lecture? I highly recommend you to think about these questions and have a discussion with your group mates, and also post your ideas or opinions on the discussion board, and incorporate your answers and opinions in the first group report that you need to turn in.